Good day. In this video, we're going to be speaking about balance sheet items. And you have to bear in mind that this is basic accounting concepts. And you will see that this is an introduction to balance sheet item series that Shaped Theory will be doing in the upcoming weeks. In those balance sheet item series, we will be explaining each and every item that you will find in the face of the balance sheet. Let's get into business. Balance sheet. What is a balance sheet? A balance sheet is a snapshot of the company's assets and liabilities at a point in time. This snapshot reflects assets, liabilities, and equity of the business. So you'll find that now the snapshot that we're speaking about includes assets, liabilities, and equity in a nutshell. And what we can say that the theory of accounting equation is reflected in a balance sheet, because accounting equation says my assets less my liabilities is equals to my equity. Later on this presentation, I will be telling you how this theory is reflected in the balance sheet. Now, let's look at common balance sheet items. It's very much important to emphasize that these are common balance sheet items. They are not the only balance sheet items that you will find in the face of the balance sheet. The reason why we just looking at common balance sheet items today is because as shaped theory, we believe that if you can understand how to treat the common balance sheet items, it will be much more easier for you to understand other items that are reflected in the balance sheet. Now, before we go to the individual items, we need to understand the classes of these items that are in the balance sheet. As I said above, we have assets, liabilities, and equity. Now, you would see that on my slide I have assets. Under assets, we have two categories. The first category is current assets, and the second one is non-current assets. The current assets are all these assets that can be converted into future economic benefits within the next 12 months. Whereas non-current assets are all the assets that will be converted to future economic benefits in periods that are more than 12 months. The first example that we'll be looking at is property, plant, and equipment. Some call these fixed assets. Property, plant, and equipment is anything that you would see in terms of machinery, computer equipment, land and buildings, and so forth. So those kinds of assets are called non-current assets, because these kinds of assets is where you would have these future economic benefits being generated over a period that is more than 12 months. Second example that we have is debtors or receivables. These are third parties that are owing you as the business. Now, these are normally categorized as current assets because we expect this particular asset to be converted into cash or any other form of economic benefit within the next 12 months. Another one is bank. Other people call it cash and cash equivalent. This is also current assets because we expect these to be converted into cash within a period of 12 months because it's cash, it's bank. It can be used within the period of 12 months or so. Now, let's look at liabilities. Liabilities are pretty much opposite of assets, but they have the same categorization as well. They have two categorizations, and these categorizations are your non-current liabilities and your current liabilities. First example that we're looking at under liabilities is loans, and these loans can be categorized as long-term loans, which is non-current liabilities, or current liabilities. Non-current liabilities, which are long-term loans, are loans that are for more than the period of 12 months. Whereas loans that are current liabilities are loans that are expected to be settled within the 12 months period. Next example is provisions and accruals. You see that in terms of provisions, in some cases, you'll find that the business will have a provision which actually is expected to run for a period which is more than 12 months. And in that regard, you'll have that provision, the portion of the period that is more than 12 months, that portion will be under non-current liabilities, whereas the portion that needs to be released to the income statement within the next 12 months will be under current liabilities. And accruals in most cases are current liabilities because are expected to be released to the income statement within the next 12 months. Another example is payables, creditors. Payables are pretty much an opposite of debtors, what we see under assets. So payables are creditors that we owe as the company. And we expect to pay these creditors in a period that is within the 12-month period. In that regard, it means these will be my current liabilities. Now, I've mentioned to you and said that I'll show you how the accounting equation is reflected in a balance sheet. You see that on my left hand side I have my assets, and if I take my assets on my left hand side and less my liabilities on my right hand side, I come to equity. This means that if you have prepared your balance sheet, you have to be able to say the total of my assets less the total of my liabilities is equals to the total of my equity. In that regard, your balance sheet has balanced. So we can see that now the same principle that we have seen in the previous video about accounting equation is reflected here in this regard in balance sheet item. And then under equity, in equity we have items like share capital, retained earnings, and reserves. Share capital is owners' contributions into the business. Retained earnings is the accumulated profits and losses that you had in the business for previous months up until now. And reserves is any kind of reserves that you have, non-distributable reserves or any other reserves that are distributable, or depending on how you value your assets. If they're at fair value, some of those assets might come to the reserves, depending on the statements that you use. But this is advanced accounting. Since we're dealing with basic accounting concepts, we would therefore have to know that in the equity side of it, we have share capital, retained earnings, and also reserves. As I've said previously in the previous slide, as shaped theory, we took a decision to introduce to you balance sheet series that we will be presenting in the upcoming weeks. Please check the next videos so that you can be able to understand all the items that are in the balance sheet. But you also have to bear in mind that now we will only be giving you common items that you see in the balance sheet, and then it will be your duty to go and look at all the other items. And we believe that if you understand these common items, you'll be able to understand all the others. We will be explaining the same items that I've explained in this previous slide: property, plant, and equipment, debtors, receivables, bank and cash. On the liability side, loans, provisions, payables, and creditors, and also explaining a little bit of equity. So thank you very much, and go and check other videos where we would be explaining all these balance sheet items. And please don't forget to subscribe to this channel. Thank you. Thanks a lot.